We all go back and look at history, but the hard thing is it's hard to remember the psychology of the period. All we've got is the charts that's left. So the psychology now is there are two big weights on the market. One is the inflation narrative. So when you take that away, the market's going to rise. The other weight is what does the recession do to the market? And people are looking at recession as recession is when earnings collapse, therefore there's another leg down into markets. They could be right. None of us owns a monopoly on the truth here. We're just trying to probabilistically frame it out. And probabilistically, I think that the markets in this current world, which is a post-interest rate world essentially, they know that the outcome is only one thing, which is stopping the increase of, firstly, stop the rate rises at no level at all. I mean, it's barely anywhere. Next is to stop the balance sheet. Then is what? It's 3 rate cuts and you're back to zero. So therefore, anything, most recessions, you need about 500 basis points of rate cuts. So what we've tended to do is use Fed funds down to zero and then use the balance sheet for the balance, because there is a rough equation, or so the central bank thinks there is. So therefore, the markets, if there is a recession, have to price 500 basis points somewhere within this, and they're just forward looking and saying, well, the cowbell, more cowbell is coming, and it's probably right.
Hello and welcome to Money Talks. In today's video, Real Vision CEO Raoul updates about market sentiments, crypto crashes, and consumer expectations as inflation continues to surge. Raoul also speaks about market testing their new lows along with his thoughts about recession and poor state for global economy. Make sure to stick around till the end of this video where Raoul analyzes the most recent economic data, risk appetite amid what remains a fraught geo-macro moment, and why this might be the most hated equity market rally ever. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. So, without wasting any time, let's dive right into the video.
It was one of the reasons somebody else has got a fear and greed index for crypto and it got down to 6. Crypto is always a very bullish market, and that was one of the signals that I used that the low was in. Look, and I've been long equities for a bit, and I've been observing this, writing tweet threads around it, that so much has been priced into equities, and we'll come on to some of those charts later, the year-on-year effects, that everybody I spoke to was starting to say, well, it's going to go down to new lows, it's going to be an earnings recession, blah, 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 and it became the predominant narrative. That's okay. But the issue is, I did a tweet poll last week or a week before. I said, how many of you think we're going to new lows? Out of the 25,000 people who answered the poll, 70%. I then said, how many of you are underweight versus your normal equity weighting? 75%. And then we look at the BOA survey that is as bearish as it's max bearish for 9 possible weeks, and the market is just ripping in a straight line. And that's telling us still nobody's participating. So I've labeled this the most hated rally. It's the same in crypto, same in macro. These rallies are utterly hated. There's a narratives the market is tied to. It's tied to, and I think you and I share all of these, I think. It's tied to oil is going up only. It's going to $200. Inflation is going to be super sticky. Equities are going to go to new lows, crypto is going to go to new lows, and bonds are dead money. And I just very much like the other side of that.
On August 14th, Bitcoin surged beyond $25,000 for the first time in months, but traders were reluctant to bet on a bull run. The pair could fall apart over the weekend and wind up owing $23,700. Over the weekend, bulls must keep the pair above $24,000. Raoul, a macroeconomic expert, asserts that he is extremely confident that the crypto markets have reached their bottom. The former Goldman Sachs executive claims in a new interview said that the macroeconomic climate that has kept the crypto market gloomy for the most of the year is starting to change. The macro is rolling over for him. By that, he means that a recession is approaching. The Institute for Supply Management, or ISM, survey and other items ought to start disintegrating quite soon, and we notice it everywhere. Therefore, that is growth vanishing. Additionally, the narrative hasn't kept up, and most commodities have decreased by 30% to 50%. Everyone is betting on the rise of oil reaching $200. I believe a washout is imminent and it drops to $60. The final inflation tale is therefore that.
I've been caught out before by soft landings. 2016 was one of those. 2015, 16, that whole period. I don't see it. My macro data is very clear that we should be going much, much lower. But I got caught out in 2016. It was the dollar back then that was looking like it was going to push the global economy off the cliff. Many economies went into the recession. The US didn't. I think that the economic damage from rates, the dollar, inflation is done. But what's confusing people is the market's job is to look kind of a year or 18 months forward and think, what are the conditions? Well, even if it's 6 months forward, what are the conditions in 6 months' time? This is kind of the Stan Druckenmiller argument. The conditions in 6 months' time, if we're all right that a recession is coming, well, rates are much lower. And if we're wrong, and it's a soft landing, equities go higher. So in all outcomes, equities go higher. So it's a matter of where was the low. So my view is we go into recession. It's pretty nasty. It's pretty quick. And the bond market's right to start pricing in a change in Fed policy at the turn of the year. They'll probably go on pause beforehand, by which case, and again, you've been tweeting about this and I've been tweeting about it. All of our work both suggests that the ISM is going to go hurtling through 50 in the next 2 to 3 months, which people aren't really prepared for. Trying to tell people. They kind of know, but I don't think they are. So I think they're going to try and sell equities on it when it comes out. And that's probably going to be a very big mistake because equities because the bond market's kind of telling us what needs to happen. But there's still a few factors in place that aren't fully in place. I think both you and I would love to see the oil market sort of break these $85 level, because I think it comes down to about 60. Then the year-on-year rate of change would be negative 50%. I think we get negative inflation in 18 months' time. And then we also want bonds to really properly break this kind of 260 level in terms of yield, because then I think it opens it up to 2%, 1.5%, 1%, depending on how deep the recession is.
Paul predicts that changes to the macroeconomic environment would first affect enterprises, then the labor market. After COVID, he claimed, people accumulated enormous inventories. Due to the economy's slowdown and the impact of inflation on disposable income, those inventories are currently unsold. So, Walmart and Amazon have demonstrated it for us. In an effort to sell it, they will start offering discounts on inventories. People are dismissing workers. Thus, the macro cycle will reach its nasty stage.
Listen, it is incredibly complex, and we all have to be cognizant of having too strongly held views. However, we have had energy prices in the past, energy crisis and supply crisis. So the ones, and I've talked about it frequently on Daily Briefing and elsewhere, 1947 to 1949 was a supply crisis because everybody came into the civilian labor force, demand shock. Supply shock was, guess what? Nobody had been doing anything, so there was no supply. So we saw 20% inflation. It went negative 18 months later, went back up again, and then settled down. The other one was 1974, which was a Arab oil embargo, and that was a massive supply shock. Obviously, the economy went down the toilet, and the equity market went down the toilet. The moment inflation turned around, equities ripped higher. So we've had the inflation tipping down. Then the other times where we had inflation, but not necessarily an energy crisis, are interesting. One was 1982, which is, Volcker, the hero kind of narrative that goes on. Well, when we raised interest rates to 18%, everyone's like, he crushed the markets like a brave man. Yeah, the equity market went down 27% and shot up like a rocket ship all the way till 1987. The next time we saw inflation behind that of 1982 was 1990. 1990, the ISM collapsed to 35. The Fed were cutting rates eventually, but what happened was the market went down 20% only. So we've got a recency bias going on here. The recency bias is 2001, 2008. Inflation is going to be driven by this commodity supply, ignoring demand. We've had examples in the past that are very clear to look at that seem to not be consistent with that. So there's the one analysis, the one only ever, was why inflation went up in 1977 through to 1982. Right? That's what's in everybody's head. You see, it's going to come back from the money printing. They're all going to pay the price. That was the glory days of gold and the glory days of the commodity investor. You know, that whole thing is a narrative construct that was driven by demographics. It was never driven by some monetary inflation issue. It was driven by demographics.
Raoul Pal also emphasized that while there is negative news for the economy, there is positive news for the financial market. Why is that making Raoul bullish? Because the outcome to that is as inflation comes down and bond yields fall, liquidity conditions improve. And what drives the financial markets at the macro level the most is liquidity conditions.
So the issue is if it's priced in quite a lot, then what is the probability of a change? One of the things is I've been long the dollar for some time and I'm getting close to closing it out because I think we're very close to levels. We didn't really break this parity level with the euro. It'll go in due course, whether it's in 3 months' time, a year's time, 2 years, I don't know, but it will go. But if the euro starts backing off, if the euro starts appreciating a bit, okay, that's a massive help to Europe because they've had the double whammy of high input costs from supply issues and a very weak euro. So what's not priced in is any ability for something to go right. You know, if I were forward looking, and I talked about this maybe for 6 months now, is the answer for some of Europe's energy issues is south of the border in Algeria. So Algeria has a lot of natural gas. It is so close to Spain. I mean, I flew there from Alicante. It's a half-an-hour flight. So they already have a pipeline. What there was no agreement was a pipeline from Spain through France into Germany. And it looked like today, and there's also, Portugal has the massive natural gas terminal, so they don't have to come through the Straits of Gibraltar and round. So with those two access points, you can get US LNG and the gas from Algeria. You've pretty much solved Europe because Europe can control Algeria much better than it, because it already, you know, Morocco's already an ally, so you're pretty much there anyway.
So, do you agree with Raoul Pal's take on recession and negative inflation rates? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.